Hello and welcome to financialexpress.com. Today we are talking to Vivek Bajaj, co-founder of StockEdge. Vivek is here to tell us how how the recent market correction, which has been ongoing for last 7-8 months or so, has attracted new investors. Uh, after pandemic, we suddenly saw a spurt in the new demat account openings, but of late we have seen that number taper off a little. Vivek, thank you for being with us today and welcome.
Thank you. Thank you for having me again.
Vivek, are you here to tell new investors who are now staying away from the stock markets to not stay away and jump in?
So it depends upon what these new investors were here for. If these new investors were here for a long inning, if they were playing a test match, then you really can't do anything with these kind of market volatility because it will happen. It's part of the DNA of the market. So टेस्ट मैच के लिए आए हैं तो फर्क नहीं पड़ना चाहिए लॉजिकली बट हाँ अगर आप T20 खेलने आए तो there is a lot of mental disturbance and emotional strength one needs to combat this kind of a market movement. So I would always recommend people to have a very long-term perspective because ultimately you are not investing in price, you're investing in businesses, and businesses take long time to give you value.
I'll just read some numbers out here. At the end of March 2019, which was the time when the pandemic was just knocking on our doors, we had 3.6 crore demat accounts. This number actually more than doubled to 7.7 crore by November 2021. So that's about, in just 18 months, we doubled the all active demat accounts. We closed March 2022 with 9 crore demat accounts. In the last financial year alone, we added 1.4 crore demat accounts. Have you seen these numbers taper off of late?
So what happens when a demat account is open? Typically, we don't close the demat accounts. Typically, because demat account becomes your wallet of all your financial assets. Just like you open a bank account, I don't think so anyone actually goes to a bank to close a bank account, right? So similarly, demat account will have your mutual funds, you'll have your equity, you'll have insurance in your demat account, and all the financial asset eventually will become part of your demat account. So this closing is not a problem. But yes, the pace of opening is definitely something which has its own moderation. So there's going to be high pace, and the pace is going to just like the way market behaves. When it goes up, it's in a hurry. When it consolidates, stays there for some time, then there is a correction. So it's just part of the overall structure of the market that demat account will open when market is hyperly active, and when market slows down, demat account opening pace will go down. That doesn't mean that demat account will become negative. The pace is moderated now.
You're a very keen observer of markets and a very active investor and trader as well. Since when did you see that new accounts opening is not keeping as much pace as it was before?
Okay, so let me just share some data points with you. If you see last 6 months, the return of Nifty, overall last 6 months, what Nifty have done, it has given a return of around minus 5.7%. Okay, if you see Nifty mid-cap return, it was around minus 5%. So mid-cap stocks have actually outperformed the broader market. But if you see Nifty small-cap stocks, index is down by 20%. Right? And most of the retail investors who come into the market, they get lured by small caps. So to answer that question, the typical relationship between demat account opening and market is relationship between small cap index and demat account. So if you see the top level of Nifty small cap index came in the month of January. To be precise, 17th January 22 was the top level of Nifty small cap index. So if you look at the data after January in demat account opening, you will clearly see the downward trend because small cap index is going down, which is people are losing interest in market, and demat account opening rate is also going down.
Doesn't that go completely against the grain of investing, which says you should buy low and sell high? Instead, people open new accounts when the market is at highs and then don't remain so active when the markets start to go down.
So there are two kind of investors. One are institutional and well-aware and knowledgeable investors who have been there, done that for many years, and they know when to act and when not to act. And then there are new breed of investors who came into the market because demonetization happened, because Aadhaar linkage happened very easily, because COVID happened. So the last 4-5 years, lot of financial inclusion initiatives were taken by the government. So new investors are coming because of those financial inclusion initiatives, and also COVID, because all of us were sitting at home and they thought it's a good time pass to do. So every time there is a market makes a new high, there is a new set of investors who come. 2000 rally, new set of investor came. Out of that, significant percentage went out. 2008 rally, new set of investor came. So it's like that, new high in number of investors, correction, again a new high, correction. And every time a new high is happening, the quantum is bigger because the base is becoming bigger. So when you say 3 crore, 4 crore people open an account, I'm not surprised, because we're talking about the base of 4 crore, 5 crore, which is leading to, from here, the next rally which will come, and it will come, because that's how the market is structured, that what is happening right now is a consolidation, and market is preparing itself for the next big move, which will take Nifty to probably 20,000, 22,000. Then number of additions will be much faster and much bigger. So this 9 crore, which is the data right now, this will become to 15 crores in probably say 2 years. The pace which we have seen in last 6 years, that pace will be outpaced in coming 2 years if market goes up to 22,000.
A little too early to talk about market rally. Rest assured, we will talk about the rally that you say it will come for sure. Let's talk about this correction first. Why do you think this correction is there, and how long it will last?
So whenever you have to understand market, you have to understand the interest rate cycles, okay? And whenever you have to understand interest rate cycles globally, you have to understand inflation. And inflation is created by demand-supply mismatch. So right now, globally, what is happening? Crude oil has gone up because of Russia-Ukraine issue. So inflation has gone up. China, there is a big problem going on. There is a supply chain issue. A simple semiconductors, which is needed for a lot of electronic communication, there is a shortage. So ultimately, who is bearing that cost of the shortage? Ultimately, the customer. Could be a producer or could be a final customer, which is leading to inflation. Higher inflation leads to higher interest rates, leads to slowdown in the economy, leads to market remaining there or correcting. When commodity prices starts coming down, when the supply chain issue is getting resolved, then the inflation base effect, because of the base effect, inflation starts coming down, which gives a ray of hope to the economy that, wow, inflation is coming down, interest rates is coming down. So now economy will revamp again and it will start prospering again. So to answer this question, very simple, check what is inflation doing, check what is interest rates doing, and then easily you can predict what is going to happen in coming few years. I can't predict for tomorrow looking at inflation, but I can for sure predict for next year what is going to happen in the market. And if you rely on my prediction, next year is going to be super market, amazing market, because typically inflation works on a base effect model. So base was low and any increase in price shows higher inflation percentage. But because base has already gone up, any incremental increase in price will not increase the inflation in percentage terms that much, which it has happened in last few months. So next year, I'm looking at very moderate inflation. I'm looking at a flattish interest rate environment and a huge market bullishness. This year is going to be tough, which was expected. Next year is going to be very, very positive.
But those factors are still there. US Fed is still talking about, people are talking about US Fed raising by another 75 or even 100 basis points.
Yeah.
And there is a lot of chatter about an upcoming recession. There is a lot of chatter about this being a bear market rally the last 2 or 3 days that we have seen. Not just in India, but across the globe as well, even the mature Western markets. The senior analysts, senior equity strategists, almost every one of them is cautioning investors that the real bear market is yet to come. What gives you the hope that next year will be far better?
Well, forget about senior analyst. Yesterday, an Uber driver was telling me there's a recession is coming. That's a very good signal that everyone has become economists now.
That's
So
partly because of financialexpress.com is playing a very big role in making
absolutely. So then you tell me how will recession come? Even recession knows that everyone is waiting for it. I don't think so. Recession will come because Fed knows much more than us. And finally, we are living in a capitalistic environment where money printing has become a weapon. And people say that money printing will come, it will lead to a lot of debt increase, which will lead to, again, a liquidity problem and interest rates will go up further. That has been there for the last 15 years. So you have to understand that the power of money lies in the hand of central banks. Only one small decision of not increasing the interest rate by 75 basis points and only increasing it to 50 basis points will change the environment. The environment changed in the month of January because Fed came out and said that I am worried now. I will increase the interest rate beyond what you are expecting. But that time also market, everyone was expecting that it will only be 25 basis points. But Fed came and said that no, I'll increase more aggressively. Today also people are expecting 35 basis points. My sense is maybe not next, maybe next to next meeting, they will start coming out with a more, more aggressive statement and say that inflation is under control. Now we know how to, because war is not here to end. Please try to understand, war is not here to end, at least till November, because November, US has a midterm election. And there is a very strong reason for this war to continue till November, because that gives a very strong fiscal impetus to US because they are able to sell more weapons to the war exercise. You know how US and other European economies work. So I am not saying war is going to happen. And I'm not saying inflation is going to go down in a hurry. But whatever you are saying is already there in the market. Market is expected, already priced in. And market always thinks 6 months henceforth. So 6 months down the line, we are talking about in the month of December, what is market expecting? So by the time December is done, I think environment will be much, much smoother than what it is right now. Until as Mr. Putin, he gets crazy one night and he presses the nuclear trigger. That is the only risk which looks apparently a risk which we all are carrying, nothing else.
Let's hope it doesn't come to that.
Yeah.
For everyone's sake, actually. Let's go back to the new investors who you said that new investors often get lured into the stock markets by a small cap frenzy or by the charm of small cap stocks, where they think that they can suddenly double or triple or even 10 times make the money. How does that happen? Why is it that the charm of small cap is so much as compared to the large cap and well established and much better known companies which are there in Nifty 50 or Nifty 100?
Okay. So, I mean, have you ever heard any large cap company going giving 20% return in a week? Not possible, right? 20% movement by a large cap company is practically not possible. But have you heard about small cap companies moving 20% in a week? Surely many companies. In fact, I love to share a few names today. What happened? So there are many companies today who have risen by, say, there's a company called Aegis Logistics. It has gone up by 16% today. 16% return in one day. Large caps will not do. So basically, people come to stock market because they want to generate a lot of return from their capital. And that is the greed which drives. And there's nothing wrong with it. When people go to horse race, they want to bet on the best horse. When people come to stock market, they want to bet on the best stock, which has highest potential of generating highest return in least possible time, which is small cap. So that is like a speculator who is trying to make return. Investor doesn't come to small cap for immediate return. So for investor, it's a portfolio allocation combining large, mid, and small, which creates that long-term wealth creating perfect equation for them.
But is that the right way for the new investors to go to put their money or to start their investing journey? or trading journey with small caps, which are inherently more volatile and more risky?
See, the answer to this question is that it has to be portfolio approach rather than a small cap or a large cap or mid cap approach. So when someone comes into the market, large cap should be higher percentage, then mid cap, and then small cap. And when the person is seasoned enough to understand the risk associated with small cap, maybe you can increase the proportion of small cap more than the large cap. But then it also depends upon the age of the person and also depends upon the risk appetite of the person. So it's a three-dimension matrix which defines what is right and what is wrong for an investor.
Since you mentioned by name and mentioned about small cap returns, which can be stellar even during a day or during a week, we'll stick with that point for a minute. Do you think, or what is your advice to the investors? Can they do that one after the other? Can they spot such good investments in small cap stocks, particularly, which can continue giving them stellar returns day after day, or week after week, or month after month, and help them grow their money so fast? Or is it just a trap?
I mean, there are some, I can't give a very black and white answer to this question. So there are some stocks which could be trap also. There are some stocks which are really valuable and still available at a reasonable price, which you need to have that eye to locate that, diamond. There is a diamond in that coal mine. You need to have that eye to locate that diamond.
Other than that, what all can investors use to spot such investments?
Typically, you do 2-3 things. One is, because someone reads a lot, you come across a lot of developments around policies, developments around sectors, and around that development you find out businesses which will get benefit out of those development. And development could be socio-political, it could be economic development, or any kind of. So for example, something happened in China because of which chemical sector became unviable there. So chemical sector of India became the next most promising sector few years ago, because after China, India is one of the largest chemical exporters. So people who read a lot, they have a higher propensity to connect the dots. The cause and effect is been able to relate better. Second, if you are around good people, your network is good, you get to come across few stocks which could potentially become a multi-bagger. Not that you just copy paste other people, but at least you get the list of stocks from what other people are saying, and then you draw your framework and evaluate whether this stock list is exactly perfect for my framework, and then you accordingly participate in those stocks.
What is the typical hit rate of a successful investor in such investments, small cap investments?
Typically, it should be around 40%. It should not be more than 40 to 50%. So what happens when you are investing in, say, let's take an example, you have invested in 5 companies, okay? And 2 companies gave you 5x return and 3 companies went 0. So 2 companies gave you 5x return, so 5 into 2 is 10, and 3 companies went 0. That means it's minus 3. So 10 minus 3, you still make 7 with an accuracy of 40%. Because you don't know which those 2 companies will be. So you will have to invest in 5 companies equal, so that any 2 which makes 5x return gives your portfolio a massive boost.
And are senior fund managers able to do that, such kind of hit rate over a long period of time?
I think so. Because if you don't generate that kind of a hit ratio, then how will you make money? And 40% is a very conservative, still lesser than tossing a coin.
Let's talk about investors who are here for a long innings, as you said in your opening statement. Such investors, how should they ride out these kind of corrections and prolonged corrections?
Investors who prepare themselves for this kind of a correction are able to handle it much better by buying the right stocks at the right price. Investors who were never prepared, who always thought that market is a one-way traffic and it will keep on going up, they are in a state of awe that, oh my God, what happened? I was not expecting this. They are facing that, I would say, crisis, that what do you do now? Because I am already holding stocks which I bought at high levels. Now, do I average? Do I exit? They are utterly confused. And that I would say is 98% of the audience. 2 out of 100 people are sensible enough because they have their clearly defined action plan. अगर ये होगा तो ऐसा करेंगे, नहीं तो plan B मेरे पास ready.
You said finding the right stock at the right price. These two are the most important questions: how to find the right stock and how to find the right price.
Absolutely. And there are science behind that. It's not a random thing. So different people have different science. Like I have a science of relative strength. So I identify stocks looking at fundamental parameters, and I only enter when the price is also showing me strength. This whole exercise, this whole model I've explained in my YouTube channel free of cost to people. So if anyone wants to learn, they can see all the videos which I've recorded there with respect to it. So different people will follow different science for entry and exit.
Let's look at the market rally which happened. Nifty went up to 18,600 in October. Now, in the hindsight, everyone can say, that was not the right time to buy, because from 18,600 it went, it fell down to as low as 15,200 or 15,300. That was about 18% correction. When the market was at 18,600, how do and amid all this noise that a market rally is here to stay, how do investors decide that this is the time to buy or not to buy?
So you have already answered that question. You have used the word noise. So when you are around noise, you can't take decisions. You have to get out of the noise which is around you. And until as you really learn this whole science properly, direct investing is not easy task. So if you can't do it, give it to a professional. Let that question be answered by a professional fund manager. If you want to do it, you have to remove that noise from the system. And for that, you need to learn. First stage is learning.
What about SIP investors? Because we have been hearing, continue your SIPs, don't stop your SIPs. Wherever market goes, if it rises, you still get units. If it falls, you'll get even more units of mutual funds, or even if you are investing in stock baskets by yourself. But even SIP investors are at a loss, because if they have purchased units when the market was at 18,600.
So you can't stop SIP, because the inherent strength of SIP is to keep on buying at every price. So one should not stop it. You may not generate the return which you are expecting. Let me warn you, because SIP cannot give you abnormal return. Over a period of 30 years, you can generate a return which typically Nifty will be giving you, which is around 11 to 12 or max 13% annualized. If you're happy with that, it's okay. If you want to not do SIP mutual fund and do direct stock SIP, you will be able to generate a better return. But sure, there's a high risk because you are generating better return.
But is there a formula to keep increasing or reducing the allocation as the markets go up or fall down?
Yes, it's called value SIP. So as market goes up, you reduce the SIP. As market goes down, you increase the SIP. It's called value SIP.
Is there any formula for that? How to calculate that?
There's no fixed formula. There's no fixed formula. Different people have different approach. Some would make it more exponential. Some will make it GP. Some will make it AP. So there is no fixed formula. Any mutual fund offering this, I'm not sure. I've not come across. So typically, investor has to manage on his own that if Nifty goes up by 1,000%, I will reduce my SIP by 10%. If reduce by another 2,000 points, I'll reduce my SIP by 20%, and so on. So this is more individual customization.
Where do you see market bottoming out in next few weeks or few months?
As I said, this year is not going to be very attractive because there's a lot of uncertainty, a lot of unknown variables, which we still have to deal with, especially the Russia war, etc. So market has tried to go up now. It's trading above 200 moving average, which is 16,500. That's a good news. Will that lead to 20,000 movement? I have my doubt because the variables are still there. Do I see great next year? Yes, I do see good next year, because by the time next year, we'll have much more clarity in all the random variables which we are facing right now.
Any levels would you like to project?
I would say that first milestone is that 18,000 level. So 16,500 to 18,000 is the journey which market has to live. How that journey is lived is important for us to make a judgment beyond 18,000. If that journey 16,500 to 18 is painful, then it's good.
Okay.
If it's very easy, then there is a.
Please explain that.
So see what happens if market goes from 16,500 to 18,000 without giving much trouble, then that means there's a distribution happening, right? And it is probably another top which you are seeing. But if suppose it goes up by 500 points, corrects by 300, then again goes up, then again corrects. It's like zigzag. That means serious people are building position in the market.
And do you think this is the time to keep building up those positions, even for retail investors and new investors?
I think the best is to do Nifty SIP and continue with your SIP. This is not the market to play aggressive stock-specific bets. Even if you play, have a very small profit, maybe 10%, 15% take profit. Keep on taking profit and move on.
Because you expect levels not to hold? Is that what you're saying?
Yes.
Okay. Any sectors that are favorable right now?
Sectors which are more cyclical in nature. For example, banking is looking very attractive because as interest rates go up, banking becomes interesting. Automobile is suddenly looking very good. Then on the commodity side, I think we still have a lot of room for metal stocks to go up. But India as a country has, because they have to control inflation, they are not allowing metal prices to go up, but it has corrected quite a bit. So maybe it can go up. Cement is always good because real estate sector overall is doing reasonably well. So cement should do good. So, I mean, more or less, you see infrastructure, country building sectors, telecom. Again, these are like the core sectors without which the country will not exist. So they will do reasonably well.
That doesn't leave out a lot of sectors. So which ones are left actually?
No, there are many sectors which we have not talked about. For example, FMCG.
Sure.
Which is a darling sector for everyone. But then when market is doing good, typically FMCGs, they don't do so well and they have performed in last 2 months also. So maybe they will not be as aggressive performers as they were earlier for many years.
But FMCG has typically been known as a defensive bet. So
Pharma.
Yes, FMCG. So why are those sectors out of favor right now?
Because they were favorable in last, FMCG has favored in last 2 months. Pharma has not been doing great, maybe a bit of, because it has done so well in the COVID time that it has become expensive. IT sector can do good. IT sector, because of rupee weakness, it can do well on a pocket-to-pocket basis. So not all stocks may do good. Mid-cap IT can do very well.
Final advice, Vivek, would you tell people to continue their SIPs and continue their investments in this market?
Absolutely. There is no question of discontinuing the SIP.
And since you have spoken so much about next year being a great year, I cannot let you go without having a Nifty target. Where do you see Nifty making high next year?
Well, as I said that, 18,000 first has to be crossed and then the next target. I'm not the person who can make very aggressive targets of market because frankly speaking, it has no meaning. I always take one step at a time. We'll cross the bridge when the bridge is there. Right now, I'm here to see the 18,000 bridge getting crossed.
Wonderful, Vivek. Thank you very much for being with us today. This was a nice conversation.
Thank you, sir. Thank you, Shaleen.